Hello and welcome back to Core Finance with me, Matt Brown. And it gives me great pleasure to introduce down the line John Eade, who is the president of Argus Research, and he's down the line stateside from Chicago. How are you today, John?
Matt, I'm great. Thanks for having me on today.
Absolute pleasure. Well, let's kick off. Equity markets at all-time highs. We've got the S&P, the NASDAQ and the Dow who just keep on pushing higher. What do you make of all that? Are we getting too high, or is there still value in these equities?
Well, Matt, I'm out in Chicago. We're based in New York, but I'm out visiting clients, and that's a question I hear all the time. Are stocks approaching a bubble? Are valuations too rich? And my answer is no, I don't think so. Yes, stocks are near all-time highs, but so are corporate earnings. Earnings are all-time highs. And interest rates, what else you might invest in, are near all-time lows. So in the context of earnings and interest rates, I'm not going to say that stocks are undervalued, but I think they're fairly valued, and I think they can move higher along with earnings.
Which is a good point. You mentioned interest rates being low, and we're looking now at the Fed and maybe looking to move interest rates higher towards the end of the year. So first off, do you think the Fed will move? And if they do, how many times this year? And what impact do you think that will have on equities?
Well, I think it could be a challenge on equities, so take that part of the question first. But we see the Federal Reserve raising rates one more time this year. So that will be 3 hikes for the year. And we think that's going to happen in their meeting in September. Then in the fourth quarter, instead of hiking rates, we think that they'll start to reduce their balance sheet and sell off or divest some of the treasuries that they bought during their QE programs. So both of those measures, raising short-term interest rates and reducing the balance sheet, I think are going to put upward pressure on U.S. interest rates, and rates move in the opposite direction of stock market valuation. So if rates are going to go up, market multiples might face a little bit of pressure, and that's why I think the earnings are going to be so important.
So if you've got an investor now coming to the market, would you be looking at investing in purely equities, or maybe holding fire and looking at bonds, for example, or if we do start seeing a dumping of bonds from the Fed, where should investors really be looking to put their funds at the moment?
Well, we're favoring equities, and depending on an investor's personal goals, they should be diversified among stocks and bonds and cash and even commodities. But in portfolios, we think those should be tilting more toward equities. If interest rates are going to be headed higher, that means bond prices are going to be headed lower. Bond prices will be more attractive maybe a year from now, 2 years from now. But right now, we think that stocks are the better value than bonds, even though stocks are trading near all-time highs here in the U.S.
And we're moving into the thick of another earning season in the US and also in the UK. But focusing in on the US, are there any highlights or key areas that investors should be looking out for throughout this earnings season?
Well, we started off with the banks last week, and the banks had good results. They're benefiting from interest rates that are moving a little bit higher. And also, everybody's watching these FANG stocks, Facebook and Amazon. And, last week, Netflix had a great earnings report. So I know there's going to be a lot of focus on these high-flying FANG stocks. But so far, they've been delivering.
Yeah, we saw Alphabet, or Google, as many will know it, report last night. And actually, albeit the headline figures were a little bit mixed due to regulations or fines from the EU. But one thing that came through, and I don't know if you've had a proper chance to look at them, the clicks or the value per click is dropping. So could it be now the likes of Alphabet, Google, certainly Amazon, who've had a great run up, may start to underperform expectations to some extent, looking at quarters going forward?
Well, these are great companies, Facebook, Amazon, Google, and they've really carried the market higher this year. If the U.S. market is up 10%, on average, I think these FANG stocks are up 30%, and that's after a great couple of years. So the valuations are a bit stretched with them, and I don't think it's time to be chasing them higher. But if you do see a non-fundamental pullback, and I would argue that there's not much fundamentally wrong with Google's business, then maybe look to pick some up on weakness.
And we spoke briefly before we came on air about the dollar, and we've seen the dollar index and the dollar basket really reach kind of 13-month lows, and the dollar's out of favor. How do you think that's going to play out with regards to not necessarily the earnings in this quarter, but maybe in the next quarter? Will that be good for US companies as a whole, or bad for them?
I think that's going to be positive. A lot of US companies sell, a third, half of their goods overseas, and when the dollar weakens, they bring more dollars back in those foreign sales. And the dollar has weakened maybe over the last 6 to 12 months, but boy, it's shot higher for almost 2.5 years, 2014, 2015, and into 2016, and it reached a cycle high. So we're not surprised that the dollar has stabilized and moved lower, just on the technicals. But even if you look at the fundamentals and you look at the manufacturing trends in the emerging markets and in Europe, they're stronger than in the U.S. So that's where the capital is going to flow, to those stronger economic trends.
And finally, because we've got you, our eyes and ears over in the US and certainly in the investment community, just to round up or finish off, Donald Trump, what's the overall feeling within the investment community over in the States?
Well, we're going to come into his, second full quarter of GDP growth. We'll get that reading this Friday. The first quarter was weak, but the economy has been relatively weak since we emerged from the financial crisis, in 2009, 2010. So there wasn't a lot he could do to really get back on track. He hasn't done much, but the U.S. markets are up 10% this year. Earnings are growing. It's almost, I'm not going to say it's on autopilot, and certainly the markets would get a boost if he were able to push through some tax reform. But right now, the economy and the markets are kind of going on their own, regardless of what Trump does or doesn't do.
Fantastic. Well, I'm sure Mr. Trump, though, will probably take credit for the uptick in stocks since he's become president.
He's at the helm of the ship, so I'll give him credit.
Good stuff. Well, John, that's John Eade from Argus Research. Thank you so much for joining us down the line today, and enjoy the rest of your day over in Chicago.
Thank you. Thanks, Matt.